Welcome, everyone. I'm Rebecca Wallenfels, an attorney with the Trust and Estates Group at Chapman and Cutler. Joining me today is Mike Jankowski. Mike is the founder and president of the Hamlin Group. Welcome today, Mike.
It's great to be here again, Rebecca.
So Mike and I have done a series of videos titled Tax Diversification, but I think in today's video, we want to highlight an important aspect about the one big beautiful bill, that tax bill that was passed earlier in 2025 that I don't think is getting a whole lot of attention. And I think people should pay attention to, both anyone who's listening to this in 2025 before we hit year end, but certainly in 2026 if you're doing charitable giving. So Mike, let me tell you about this provision of the OB3, as I like to call it. One of the things that the OBB has in there are some provisions that impact charitable giving. Some of them good and some of them maybe not so good. But there's two provisions I want to talk about today and highlight. The first is that one of the things OB3 introduced that is brand new to the tax code that didn't exist before is there now is a AGI threshold of 0.5% that you have to get over in your charitable giving before your charitable contributions are deductible. So basically, it's 0.5% of your adjusted gross income haircut. Now, before this, most people might have thought of that as it exists for medical deductions. There was like a 7.5% threshold that existed before. Certain deductions, historically, there was a 2% threshold. So this is brand new for charitable deductions. There's now a 0.5% threshold. So whatever your adjusted gross income is, you take 0.5% of that and you don't get that charitable deduction. The other thing that is there in OB3 that some people might recognize exists, but don't think about it in the context of charitable giving, and that is once you hit the maximum income tax rate, that 37% tax rate, so you're in the highest bracket taxpayer, there is a 2% limitation on itemized deductions. So when you make a gift to charity, it's an itemized deduction if you're itemizing on your income tax returns. And so they got rid of certain provisions of the tax code and added in new ones, and this is another new one. So all itemized deductions now, once you're in that 37% tax bracket, 2% of your AGI gets phased out of any itemized deductions, and that includes charitable gifts. So now we have a haircut at the bottom and a potential haircut at the top if you're in the top tax break that's going to apply to your charitable giving starting in 2026. So that's the other thing to know is this is a new rule, starts in 2026 for 2026 gifts. It doesn't impact 2025. So for those of you who are listening to this video in 2025, it's not here year end. Got to think about those 2025 charitable gifts. You get more bang for your tax dollar deductions in 2025 than you will in 2026. So with that, Mike, you've done the series with me about tax diversification. How does someone deal with this new tax rule in 2026? What do they do? What happens?
Well, I think this is going back to the old days where CPAs used to tell clients that when they lose deductions, which was based on the standard deduction, now we've got something or layered something else in, but the remedy was twofold. One, they found a way to bunch things they would be doing in 1 year, like prepay charitable donations through a donor advised fund or just outright gifts to their church or charity. And they would work and play around with that. The key to this is a little bit different because of the tie-in with AGI. So that kind of fits in nicely where we marry the idea of trying to cram in more deductions in 1 year and fall on the sword for standard deduction in future years, where if we were able to use more tax diversification, we could literally reduce a person's adjusted gross income moving forward, regardless of the year we work with tax diversification. So let me give you an example. I had one client who basically converted almost $4 million of an IRA to a Roth IRA. And when he got done doing that, you took a look at what happened with his tax liability in future years, he zeroed out taxes. It was kind of like irrelevant at this point because whatever income you would show would fall under the standard deduction. And it basically, this law wouldn't have affected him at all.
Right.
So I think the key here is finding a way through tax diversification to reduce your AGI, whether it happens this year, which would be ideal, or whether you have to do it sort of like what I mentioned before for 2026 and beyond.
Yeah, yeah. And you and I want to do a video maybe diving into more detail about what OB3, all of the tax provisions in there, just for people's interest. But I thought this wasn't a particular one to highlight. But I do like that idea of, again, this emphasizes the need to have tax diversification in place. Because as you point out, one of the benefits of really looking at your wealth overall through that tax diversification lens is one of the goals we want to achieve is your ability to control your AGI in future years. And then, tax law changes like this, but even, for those clients who are charitably inclined, they're not as impacted by this change, and we can get a little bit, maybe more better bang for our charitable dollar.
And to complete the loop on this, back years ago, and this goes back to a lot of years, maybe not that many years. The key here is if you insulate yourself from the federal government when it comes to tax diversification, a lot of these law changes just kind of like, it's like water on a duck. There's no issue you have to be worried about because you're already insulated from those kind of tax law changes. And to this point, I think a lot of professionals, a lot of clients slash donors, a lot of people who are, the clients, the not-for-profit organizations, I think critically, they need to really look deeply on this because, this is going to be a reaction type of thing only too late for people when they start to say, well, wait a minute, what just happened here? Why didn't somebody tell me here? We're tax reacting versus being tax proactive.
Yes, yeah, that tax proactive, right? Because some people might not notice until they're filing their 2026 tax return in 2027. And that's far too late. You want to not only know about it now, but as you point out, be insulated from these types of effects. So you don't have to worry when, OB3, number two, gets passed. Because there will be some more tax law changes, I'm sure.
Yeah, it's been the history. And like I said, it's not worth, maybe it's worth repeating. You need to insulate yourself from the federal government using tax diversification while building your wealth.
Excellent. Well, thank you, Mike, for joining me today and giving us this very sage advice and reminder about the benefits of tax diversification.
Everybody, please get a chance to talk to your professional advisor, your non-for-profit, and kind of scheme out what could happen. Of course, you could talk to us because our contact information is at the back end of this video with more to come. Thank
Wonderful.
you.
Thank you.